Thanks for being back, and let's start off with what is happening out in the economy with stimulus now is being pumped into the economy in the U.S., in Europe, and here in the U.S., they're tapering off the stimulus. They're raising interest rates. What effect will this have on the stock market, the housing market, the auto market if the Fed continually raises rates and cuts back on the stimulus here in the U.S.?
Well, history shows us anytime you get into a rate hike cycle, they generally overdo it and they choke off whatever recovery or whatever impact the low rates had. But one thing that's happening that's different is right now the United States has abandoned the, as Janet Yellen used to say, highly accommodative monetary policy. They've now gone into highly accommodated fiscal stimulus, meaning the tax cuts. So where monetary policy has slowed, they're now counting on not just, quote, escape velocity, that the economy's reached that because of the stimulus that the Fed has done with the low interest rates and the QE, but now they've added tax cuts, and they think that's going to take it into the second leg. But the United States, or the Fed, cut its started its rate hike cycle and stopped its QE precisely at the time when one might think they instructed the Bank of Japan to start theirs. The Fed stopped QE at the end of 2014, and immediately the Bank of Japan launched a huge QE, which they're still doing. They have negative interest rates. The ECB started QE at the direction of then Vice Chair Fisher, who's big buddies with Mario Draghi, and they started QE, and now the QE that the ECB has done, I think, is over $5 trillion, which dwarfs the $4 trillion that the Fed has done. Then you had the Swiss National Bank doing its own form of monetary debasement and printing francs and buying U.S. stocks. And then you've got the Bank of England with a zero interest rate policy. They're buying corporate bonds. ECB, I think, has almost run out of corporate bonds to buy. So I think what will happen with the Fed is they're going to get to a point where they're going to have to stop raising rates. And at that point, when they stop raising rates, it'll be the turn of the other central banks for them to start raising them. They're all in this together. They all have to, as you might say, pass the potato as to who's easing and who's not. And right now, it's the United States' turn to push up the interest rates and stop the QE, and it's time for the rest of the world to stimulate. And then the United States figures the reason the Fed had to raise rates was they couldn't be the world reserve currency and have them at zero forever. So they had to create some room between themselves and the other central banks. And while the other central banks lowered their rates, did QE, it makes the Fed look like it's prudent. And that gives credibility to the whole debt-based scheme because it looks like the whole world isn't going crazy when in fact it really is.
Now, at what point do you think that they'll stop raising rates? Do you see a target where they're going to be like, okay, this is enough? Because we've seen back in 2006, 2007, when they raised the rates then, they reached a certain point where then housing started to fall apart, the economy started to fall apart. Do you think they're going to raise the rates, like maybe one or two more times and then stop before all that happens?
I would think that's what they should do. They still have this ridiculous, they have to have 2% inflation. And that's when that guides their monetary policy as if the inflation rate is what drives an economy. They'll probably overshoot as they always do. But also, we have to consider what impact will the fiscal stimulus do, meaning the tax cuts. That could have a salubrious impact on the economy. And they're Trump is talking about doing another tax cut before the midterm elections. That would also probably provide a stimulus that could also generate some of the inflation, which would make the Fed probably want to continue to raise rates higher. I think they want to get away with as many rate hikes as they can so that they have enough space so that when it's time to start lowering rates, that they can do something more meaningful. Like right now, they've done 7 rate hikes. If they can get 2 or 3 more in, that means they can do 9 or 10 rate cuts. Small rate cuts if they need to stimulate the economy. But the real issue is they're trying to manage the dollar and they're trying to manage the stock market because those are the 2 big assets that the United States has. And they seem to be able to manage the stock market irrespective of what they do with interest rates. Many suggest that that could be the exchange stabilization fund. It could also be a coordinated effect of other central banks knowingly or ones that we don't know about buying U.S. stocks. We know the Swiss National Bank has $100 billion worth of U.S. equities. Indeed, they don't just buy the blue chip stocks. They buy stuff that doesn't make a profit like Tesla. They have a whole unicorn portfolio at the Swiss National Bank. So it looks like the whole world, all the central banks, not the world, is working to keep all of the paper assets inflated and to give value to each other's debt obligation, because all the countries buy not just debt from the sovereigns, but they also buy the debt from the large corporations. And the large corporations like Google and Apple also buy a lot of U.S. treasuries. I noticed that Apple has $56 billion worth of treasuries, and Google has about $51 billion worth of treasuries. That's more combined. That's more than Korea, Russia, Canada, France, Germany, Thailand. So there's this enormous appetite, and they've created this appetite for debt as an asset. So they all buy each other's debt. They all believe in it. And China still holds $1.1 trillion in U.S. debt. And they run on U.S. debt because their state-owned enterprises, state-owned banks issue U.S. dollar denominated bonds. I think Chinese banks issued $120 billion in U.S. denominated debt just last year alone. The Chinese government, the People's Bank of China, issued a $2 billion U.S. bond. So the whole world runs not just on U.S. dollars, but runs on a combination of U.S. dollars, euros, and the rest of the country's debt obligations. And that's what they all have a vested interest in propping up. And that's why it's almost, people say, well, we're going to overwhelm the free market, will overwhelm it. To me, it seems like all of these banks and central banks have basically ring-fenced these markets, and they run the casino. And I'd like to say you don't beat the casino at the casino, and you follow what they want you to do, which is buy real estate and buy stocks. The last 10 years, that was their plan. They wanted to create a wealth effect. They don't create economic growth. They create this wealth effect where they boost asset prices, and they do that by they control how much, quote, liquidity goes into the markets, either by printing currency or buying each other's debt. And that's what's kept this whole thing going. It's astounding. But the reason it keeps going is, other than perhaps gold or to a lesser extent silver, there isn't an alternative. And that's where this thing could go on a lot longer. And it's gone on a lot longer than any of us would have imagined, because in past times when you always say that fiat currencies don't last forever, and that's true. But usually when one fiat currency dies, it can go somewhere else. So, for example, if the Argentine peso died in the 20s, well, that's fine, or the Hungarian florent, whatever. It could go to, at the time, the dollar, which was backed by gold under the Bretton Woods standard. Today, there's nowhere to go, so they all realize that, and I think they all support each other in this, and only a few countries that are outside of the system, like Russia, maybe Syria, and Iran, those are the only countries that really have a vested interest in not being part of this, because they don't run these big deficits. Russia doesn't have a consumer economy. It's not debt-based. They don't have a lot of external debt. They've got 18% of the reserves in gold. They have only $45 billion in U.S. treasuries, and they're oil-based. But most of the world isn't set up the way Russia is. And ironically, as we were talking in the pre-interview, the ruble is a very weak currency, even though it's got an 18% gold reserves, it's got a lot of oil exports, and it doesn't have a lot of debt.
Now, Russia, they're selling treasuries right now, and they're purchasing a huge amount of gold. And I think you report on this all the time that, Russia is constantly adding to their gold reserves, and they just continually do this. What's your take on why they're continually adding more and more gold to their reserves?
Okay, so Russia has the second largest gold mining production in the world. Russia also has very little trade with the United States. Russia's been under two sets of sanctions with the United States and also with Europe for the longest time. So what Russia figures is there's no real reason to hold treasuries other than, unfortunately, for most central banks, it is the reserve asset of choice because other countries accept it, and it's a sign of having something prudent. That's just the way it is. That if you look at current reserve assets right now, the United States dollar makes up this is according to the IMF, just the first quarter, 62.5% of all foreign reserves. And then the euro is like 20.4%, the Canadian dollar about 2%, the pound 4.5%, the yen 5%, Australian dollar 2%, and then there's about 1.4% in Chinese RMB. So if a central bank is going to hold reserve assets, the most prudent thing to hold would be gold, obviously, and then U.S. treasuries. Now, Russia has a large gold mining production. So what they've been doing over the past, I think since 2008, they've been adding gold to their reserves at a pretty big pace. They added 224 tons of gold in 2017. They added 199 in 2016. I think they added, maybe 210 or something in 2015. And they've gotten their gold reserves up to about 18% of their overall reserves. Now, they mine a little bit more than that each year. And the remainder of that gold goes to China because China has a voracious appetite for gold as well. And China is the number one gold producer. So they add gold not just to the reserves, but to their state-owned banks and other sovereign wealth funds in the country and other, communist Chinese leaders. Rich people also have a lot of gold. And then there's a lot of gold traded on the Shanghai Gold Exchange. So Russia's been adding since 2006. And right now they're at about 1,900 tons. Now, that amount of gold is worth about $82 billion, about $80 billion, which it's a large amount of gold, but it's not a large amount of dollar notional amount. When people get excited about Russia's gold holdings, it's significant, and it's a sign that because Russia is doing it and they're guiding their central bank affairs a certain way to gear towards gold. But the more important gold numbers are how much gold India imports, which, for example, Russia added 224 tons of their 350 tons of gold that they produced to the Central Bank of Russia. But India imported 906 tons last year. China also pulls in an enormous amount of gold through Hong Kong. China also mines about 450 tons of gold a year. Most of that doesn't make its way to the People's Bank of China's balance sheet. As I mentioned, the People's Bank of China is now behind Russia. The Central Bank of Russia has managed to pass the People's Bank of China in gold reserves and now has about 1,900 tons, over 1,900 tons. And People's Bank of China is stuck at 1,842 tons. Now people say, well, they're lying. Well, it's obvious that there's more gold in China than at the People's Bank of China because we know that over the past 15 years or so, China's mined about 5,500, 6,000 tons. They've imported about 10,000 tons into Hong Kong. We see every year that the Shanghai Gold Exchange has 2,500 tons of gold withdrawn. So there's an enormous amount of gold in China. And there's an enormous amount of gold also. It's just not on the People's Bank of China's balance sheet. And there's an enormous amount of gold in India. And people estimate that India and China, within the confines of those countries, each have about 20 to 24,000 tons. Now, India, the central bank or the Reserve Bank of India, only has 557 tons of gold, but it's where the people have it and the temples have it. So Russia is doing what, I forgot her name, Elvira, whatever the chairman of the central bank is. They decided when they went under sanctions, and this is strange because the United States, most other countries wouldn't do this. When they went under sanctions and knew they were going into hard times, they made a goal to increase the reserves from 350 billion up to about 500 billion, and they're slowly heading there. They're almost at 500 billion today. So in bad times, they've managed to increase the reserves, whereas most countries, they would launch a stimulus and they borrow money to offset the negative impact of the sanctions. So they're not doing that. And what they have done is they've lowered their U.S. Treasury holdings And they did it all in one boom. People were saying for the longest time, Russia's dumping treasuries. They weren't. They had about 100 billion for the last 12 months. And then boom, in April, they dropped them down to about 47, 48 billion. And they've just steadily been adding gold. So they rebalanced their treasury to gold ratio, and they've increased their position. So Russia's in the best position to ride out any type of debt type of collapse because they really don't have any. And they also have a decent gold position.
Now, we also see other countries, they're repatriating their gold. And we also see Kazakhstan, their gold reserves, aren't they past the United Kingdom right now?
Correct. I started tracking Kazakhstan. They caught my eye about 2 years ago, and I report on them monthly. They also have become a top 10 gold producer. And what they've decided is that there's no point, and just like Russia, if your currency is weak, and your domestic economy produces a gold and you have rubles, why not exchange the weak economy for the ruble? You make the increase almost instantaneously. Well, Kazakhstan's the same way. They have the tenge, I think it's called, and they've increased their gold production. They've added an increasing amount of gold to reserves. They actually beat Russia in one aspect of gold accumulation. They've added gold to their reserves 69 straight months. Whereas Russia's had a few months where they stopped buying because I think they have a target for the year that they want to hit. When they hit it, they may slow down in a particular month. But Kazakhstan now has, well, they had 314 as my last report. They just reported their May numbers 2 days ago. They now have 318 tons of gold. That places them ahead of the United Kingdom, which only has 310 tons. Now, if you think about it, Kazakhstan is a relatively small country in terms of GDP. England is supposedly the home of the city of London and a big major player. The pound is a major reserve currency, well, not major, but it's still in the strategic drawing rights of the IMF. And yet Kazakhstan has a larger gold position than England. A part of that's because England sold their gold off in Brown's Bottom in the early 2000s, and they used to have about twice as much gold as they have now. But still, for a country like Kazakhstan doing the smart thing, taking their domestic mining supply and adding it to reserves, they now have, I believe, about 40% of their international reserves in gold. So it's a significant thing because Kazakhstan is not a major economic power, but is becoming a major central bank gold power player. Now, the amounts are small. They had 4 tons a month, but the fact that they're 15th and they used to be like in the 40s in the league tables is fairly significant. Turkey's doing the same thing. Turkey has added a lot of gold and has exhorted their citizens to do the same. Now, Turkey, the price of gold in Turkish lira has skyrocketed because the Turkish lira is not doing very well at all. And so they're also not just adding gold to their central bank, but also to their other banks, which under some strange trick of what they do, they report to the IMF the gold in the banks and in the central bank. But they're also importing a lot of gold into Turkey that doesn't, just like in China, it doesn't end up on the People's Bank of China's balance sheet. It doesn't all end up in the Turkish balance sheet. So countries with weak currencies, like the ruble, the Turkish Turkey, the Turkish lira, they're more apt to need to buy gold and to have gold as a defense against a crumbling currency. So I think that's what's going on with the central banks. China doesn't want necessarily to defend its yuan. It likes to devalue it from time to time. And I think that's probably why they don't add gold to the PBOC balance sheet. They prefer not to. They prefer to hold that gold at other places so it doesn't impact the value of the yuan overall.
Now, what about the United States? Are there any reports that the United States is bringing in gold or actually has any gold?
Now, that's one that, like all these numbers, any of them, you can't really trust what any of them say. People have biases as to which ones they wish to believe. What What counters against the United States having or not having gold is the main thing, I think, to my mind, is that the gold at Fort Knox hasn't been audited fully since, I think, 1950, whatever. So that is a red flag. But I think it's more likely that the gold is there. And I might even say maybe it's not even hypothecated. Maybe it is there. But the reason that the United States doesn't audit it, doesn't talk about it, is they don't want anyone to think that somehow gold is important in the grand scheme of things. Remember, they want people to think the dollar is important, the dollar as the dollar, not the dollar is backed by gold. So if you remember the whole purpose of the petrodollar agreements back in the early 70s when Nixon ripped up the Bretton Woods agreements and said to the foreign central banks, you can no longer redeem your dollars for gold here. But then Nixon said quite arrogantly, but the dollar is still the dollar, and it's based on the goods and services that are produced by the country. So I think it's more of a function of the United States just has it, does not want to make a big deal out of it. And if you read, I did a search once about a year ago, if you look at all the Federal Reserve speeches and quotes and whatever they say, they never mention gold. So it's almost purposely they don't want to draw attention to it. And the only time you ever hear the central banks talking, or the Fed talking about gold, was when Ron Paul used to ask about it. Otherwise, they don't raise it, and I think that's intentional. So I think they're trying to downplay the significance of gold. And even so, the United States supposedly has 8,133.50 tons altogether, of which 4.7 tons, 4.7 thousand tons are supposedly in Fort Knox. I think they just don't want to mention it. I don't think it's a funk, because if the United States thought that having gold was essential and important, as I mentioned, Russia's gold hoard could cost $83 billion to go out and buy tomorrow. Now you say, well, they could never go out and buy 1,900 tons without anyone knowing about it. Well, you could, and it wouldn't impact the price. Here's why. As I mentioned earlier, India imports 900 tons of gold a year approximately. That doesn't move the price one spit. In fact, it went down when it moved that amount. So if the United States actually, for some reason, didn't have gold, it could print up, or any country could print up money and buy the gold. I think the reason the U.S. does it, and countries other than Russia, Turkey, and other countries that are somewhat outside of the whole debt Ponzi scheme, they don't buy it, is because they know that that undermines the fiat scheme in which they're involved in. Now, you mentioned repatriation. That's important because even though they all realize they have to stick together in issuing debt, and they all know that it's a mirage, that they say that they have X amount of reserves, millions and billions in reserves, and most of it's in U.S. treasuries or euros or whatever it is, they know that that's not backed. So what they wanted to do is at least bring home their gold, or at least have it nearby, so at least they know they have that. What's interesting is they haven't added to those gold reserves. All the countries that have been repatriating the gold they're not adding additional gold. And part of that is, little known, but if you go to the World Gold Council's site, you'll see they have agreements not to buy or sell gold amongst the central banks. So it's manipulated even there, where they're not allowed to cheat and go out and add gold to the reserves. No one's stopping them from repatriating it, but they're not adding to the gold reserves. In fact, they did an article for Zero Hedge that shows that Germany loses about 4 tons a year in gold, not because they're selling it, but because they are selling it. They're selling it to the government to mint German gold coins. Now, you would think, why would they allow that to happen? Why don't they just replace that gold after they sell it? Why don't they add to the gold reserves? But if you look at the major gold-holding nations, Germany, Italy, France, the Netherlands, India, Belgium, they don't add to their gold reserves. The only ones adding were China, which stopped adding gold in October 2016. When I say China, I mean the People's Bank of China. Russia openly is adding gold, as is Turkey and Kazakhstan. The rest of the countries are stagnant.
Well, the rest of the countries are stagnant because under the agreement, they can't add more gold. Now, why do you think they put that in there?
Because I think it's just like why I say the United States probably does have the gold, is because they don't want to emphasize gold. They know that they've put all their marbles into this, I'll buy your debt, you'll buy my debt, we'll run off of dollars, we'll run off of treasuries, we'll run off of euros, we'll run off of yen. Look at the Bank of Japan. The Bank of Japan, how could they get away with this? The only reason the Bank of Japan has stopped buying treasuries is because the Bank of Japan buys just about every Japanese bond on the planet. So they're locked into the paper game. They can't break out of it because if they did, it would expose the entire system and people would start to look to gold as being more valuable than they have it set at or manipulated to. So no one wants to step out and do it. The only ones who are doing it are Russia, and it makes perfect sense for Russia to do it. They're on the outs as it is. They're an outlier, and they're lucky enough to have gold reserves on site in their country, and they have a weak currency, so it makes it and they're not part of these arrangements, so it makes total sense for them to have it. And they don't need to have a lot of dollars or treasuries lying around because they don't have a lot of trade with the United States. But the rest of the countries are all tied at the hip together, including China, European countries, Australia, Japan, United States. They're all part of the same system. So that's why they've all agreed to trust this system of U.S. treasuries and other debt securities. That's how the world runs.
Now, since everything is connected, like we're saying, and they're, moving the potato around, we do see certain things happening in the economy, like in Australia, Canada, like the housing markets there, where, the prices of homes were, skyrocketing. They're starting to fall. The same thing in the United States. We're starting to see prices decline. And because the rates are moving up, we're starting to see mortgage applications decline, and it's kicking a lot of people out of the market. Now, aren't they nervous and afraid of, something like that, where all of a sudden you see prices decline, traffic drying up, people not purchasing houses, where this might, turn into some type of snowball effect and they won't be able to stop it, and it might just destroy the whole system because of, the housing market coming down, which affects many other markets.
Yeah, here's the difference between the last housing crisis and the one that may come up now. Back then, if you look at the number of new homes sold and just existing homes sold, it was 2, 3, 4 times higher. What they've done this time is they have reflated the housing prices in the United States, but not the sales, because we've moved more into renter nation. So the real issue in the last housing crisis was the extent of the number of foreclosures. Today, the people that have bought these houses and moved the prices higher, 40 to 60%, depending on the market, could be as high as 90%, bought them with cash. So there's not going to be the same foreclosure issue. There's just going to be the loss in value. But a lot of people, a lot of investors who own homes, they don't hold them anymore necessarily for the increase in value. They're happy to take it, but it's also a place just to park money that no one knows about. The big thing they're trying to do, and it dwarfs the real estate, is they know that there's a limit to how high you can boost a home price, because they're based on income in most cases, or the ability of somebody to pay cash. So in a residential community, middle class area, house is $200,000, $300,000, $400,000. They know they can't make all those houses go to $5 million because people can't buy them. They don't have the income test, and there's not enough people with cash who just buy all those houses. What they like to focus on is the stock market. Stocks right now are totally devoid of any rational basis to. You don't have to, like for a house, there has to be a rational basis somewhat. That has to be based on income to debt ratio in order to buy a house. You have to have a little bit down in most instances. But you got a company like Tesla. It can go to wherever it goes. In other words, there can never be a price too high for a stock or too expensive for anyone to buy it. It may be overvalued. It may be ridiculous to do it, but there's nothing stopping a stock from going from $800 to $1,200 to $2,400. You can say, well, there's PEs and there's other restraints. Not when you have Tesla. There is no PE. There is not even a price revenue. That company really, when I started doing securities work 30 years ago, 20 years ago, it would never have gone public. It has no track record of ever earning a profit. It probably never will. So they like to focus on. That's why the Swiss National Bank buys this type of stuff. What they've done is they've destroyed the concept of value, real value, not just by downplaying gold, but by boosting the stock market so that people feel comfortable buying stocks that make no money. This Warren Buffett thing about value investing, that's long dead. Warren Buffett doesn't make money now by picking the right stocks. He makes money by buying the ones that he knows that are backed by all the other people that are buying the stocks. So I'm not sure that the housing market is going to be as big of a deal. It's probably a bigger deal in Canada because it never collapsed, and in Australia. But in the United States, we haven't seen the home sales, both the new or existing home sales, rise. And as I mentioned, a lot of them were cash-based. So what they can control, and the reason they don't like the housing market as much as they like the stock market, is when you have a housing collapse like we did last time, you have societal issues, you have empty homes, banks have all these assets lying around, they don't know what to do with them, they become the target. Stocks, they seem to have the ability to boost stocks. And if we did have a stock market collapse or correction, they can easily print up each other's money and debt and buy more. And that's what we've seen. We've seen the stock prices since 1987, even though we've had a crisis in 2008, 2009, they just go straight up. I remember in the 70s and 60s, the prices of stocks would go down and you could have years where they went down. And it was all based on fundamentals and what the companies were doing and how well they were doing. And in a recession, they didn't go higher. Today, stocks go up just because. So I think that's what they've decided to push more of their money into are bonds and stocks. And they've managed to keep these prices elevated across the world. Now, China's got a problem right now because the Shanghai exchange has dropped 20%. And you know they're going to pump more money into the Shanghai Stock Exchange to try to boost that. I think actually China is the place where the whole thing could fall apart because they've created more debt than anyone. They're the ones who are reliant on debt for their growth. They're the ones who have built bridges to nowhere. They're the ones who are doing the Belt and Road. They're doing anything they can to create GDP via debt and to create jobs and growth. And at some point, they've realized, the Chinese Board of Governors, the head of it said, we may reach a Minsky moment if we haven't already, meaning that they may have already issued too much debt. So right now they're trying to deleverage. And what's happening with the deleveraging, it's slowing the economy. And then boom, they get hit with this tariff stuff. And now they have to print more. You want to subsidize the companies that may get hurt by having to pay a tariff. So China's in the position where, and they also have unfunded liabilities just as big, if not bigger than the United States. So China's in the point where if they have to deleverage, they're worse off than any of the other countries who don't have much growth, and their growth isn't necessarily based on debt. They're kind of on an even keel. As we talked about, the United States has very low GDP, so do most of the countries. But China has high GDP, and that's helped fuel their ability to move 400 million Chinese people from the country into cities. They can't just send them back. So they have to keep the whole thing going. And that's where China, I think, is the weak point in the entire debt Ponzi scheme, because they're the most reliant on it, and the world is relying on China. They're the ones who took the world out of the recession. And even when the recession supposedly ended, they kept going. They've been at this since 2009. I think they've poured more concrete in 5 years than the United States poured since 1880 to 2010 or something like that. So they are a massive economic engine. And if that slows down, that's going to be a case where they're going to be hurt. And the problem right now they have is they have all this dollar-denominated debt, and the dollar is going sky high, and the yuan is going down, and they don't really have much. There's not much they can do about it. So that's what I'm most concerned about is China, not a collapse in asset prices, because asset prices can be boosted just because, as we've seen, there's no limit. I mean, they could do $10 trillion worth of QE. In fact, the Fed was talking about, Yellen, before she left, that the next QE may involve equity purchases. So if the U.S. stock market goes down, she can go over they don't have the authority to do it. They can go over to the Congress, and Congress will say, oh, you can fix this? Sure, go ahead. Put aside $2 trillion and buy stocks. And the stock market would go nuts if we found out the Fed was going to invest. And that's the problem, is they boost these stock prices beyond any recognition, and that's what they've been doing.
I think the central banks, I think they are worried that there's problems in the economy because just today out of the Wall Street Journal, they're saying that the next recession may hit in 2020. Christine Lagarde from the IMF is saying that the EU needs a rainy day fund to prepare for an economic shock. The Biz is saying, and this is coming out of their latest annual economic report, that, a lot of the banks, they might have been, manipulating, using Lehman-style tricks to disguise their debt. And, maybe these banks aren't as strong as they are saying. So it looks like they're preparing for something big to come, and they're trying to protect themselves by putting this out, right now to let people know that, yeah, we know there's problems. It's not us, it's them. And I mean, that's what it seems like in the Wall Street Journal, where, just a couple of years ago, all these corporate media outlets, they were saying the economy is fantastic. And now we have and I know the numbers are, manipulated. Everything's the same. The calculations, they're using the same calculations, but using the same calculations for unemployment, GDP, the corporate media is now saying with the lowest unemployment using the calculations that Obama was using, they're saying that we're heading towards a recession. Now, why all of a sudden did they start to switch all of this where they're saying, yeah, something bad might be coming?
Because something bad will come. The only difference between now and last time is they've already established a precedent that they know how to handle it by issuing more liquidity, issuing more debt. So actually be a good thing for them if the whole thing collapsed, because now it's just a rinse and recycle where now they can let the asset prices fall down and they can pick them all up on the cheap. And in this recession, they don't get hurt no matter what happens. They win on the way up, they win on the way down, and they win on the way up again. So they realize at some point, maybe it might be a good thing to allow things to fall back down. They have less of a housing issue this time because there's not as many people in housing that are indebted. The issue also with cars isn't that it's big of a deal because people default on the cars. And what they do last time, cash for clunkers, just roll them up. Someone will take them. We'll send them to China. So they've figured out now how to handle these collapses that they create. And they stand ready, willing, and able to reflate this stuff all over again. And I think there will be something, and they know how to deal with it because they are the ones in control of these markets. It's not the free market. They run the casino. They know when they accept each other's chips. So there's not this, they've managed to convince the world or run the world on the debt scheme. And they know they value debt. So what'll happen is if there's a collapse, they'll issue more debt and reflate the asset prices. It's lunacy.
Louis, thank you very